Silver Lake Financial Projection, an introduction to the advanced capitation healthcare model. First, let's see the concept of capitation. Capitation is a payment arrangement for healthcare service providers, such as physicians or nurse practitioners. It pays a physician or group of physicians a set amount for each enrolled person assigned to them per period, whether or not that person seeks care. For the past few decades, both government and the insurance industry have tried transforming the healthcare delivery system by having physicians accept a transfer from fee-for-service to a payment model based on some form of capitation. Both stakeholders viewed capitation as a model for cost reduction, while physicians viewed it as an unacceptable form of risk transference. Presently, those opinions held by the physicians are shifting due to the capitalization model being introduced by private equity that promotes both horizontal and vertical integration of the community healthcare system. Once the initial capitalization is made, the shift to the capitation can be made profitable once alignment with the accountable care organization is formed. Here are the results. Our acquisition target is Silver Lake, a primary care practice in the Southwest. Our financial projection aims to predict the practice's performance in the next 10 years. As for information source, patient census came directly from the practice. Financial data came from tax returns, balance sheets, profit and loss statement, statement of cash flows, and billing records in the form of 837s and 835s. The practice will have a steady growth. Part 1. Assumptions. Basic assumptions are shown below. On the Assumptions tab, model starts on 2015, December 31st, predicting the performance in the next 10 years. The practice is in a tax bracket of 40%. The practice will always retain a cash balance of $1 million to prepare for immediate use. As for patient structure, at purchase, total unique visit patients is 26,000, including 12,000 attributed patients. Ancillary patients are 25,000. As for transaction and financing, we designed 5 most possible cases for these assumptions. For example, let's see case 5. Choose case 5 in the drop-down box. Then we will use the case 5 assumptions, under which the fee for service per member per month is $19.9. Capitation per member per month is $750. Healthcare cost is 5%. Then the whole financial projection is processed under case 5 assumptions. All data in case 5 is from cms.government. On Manipulate Entries tab, we show the method to customize your own assumptions. In one word, manipulate the blue values on assumption sheet and do not change numbers on other sheets. Because in this workbook, blue numbers are absolute values. When we plug in different values, the whole workbook changes automatically. While numbers in black and green are cited from somewhere else or calculated, we cannot plug in numbers here. Under certain assumptions, we can continue to see the predictions under these assumptions. Part 2. Projection Overview. This part tells us the quick information about the projection. On the Summary tab, we can see a summarized simple income statement and balance sheet. In the income statement, revenues and operating costs increase every year, and as a result, EBITDA increases steadily every year. Net income will reach $18.8 million in 10 years. Profit margin increases from 7% to 8.5% in 10 years. Below is the simple balance sheet. On assets side, we always hold a cash balance of $1 million to meet daily operating needs. The excess cash from profit will be transferred to investment account to make more earnings. The investments will be worth $136 million in 10 years. On the liability side, we don't hold debt. On Financial Overview tab, we can see a more detailed income statement and balance sheet that shows the data concerning financial ratios. For example, revenue sources and costs and accounts payable. On Transaction Overview tab, it shows that how funds are raised and used at purchase. Funds all come from equity and are used to purchase the practice, pay for ECO prepayments, PP&E, and other deal costs. The total equity is $25.6 million. On Returns Analysis tab, we show the shareholders' investment future. To sum up, shareholders invested $25 million in the first year and get a big earning of $63 million in year 5. The projection IRR is as high as 19.7%. Like mentioned at start, the assumptions are made in a conservative way. The real IRR could be higher. The practice is a good investment opportunity. On IRR tab, previously we assumed that we pay 5 times EBITDA to purchase patients and other costs. In total, equity should be $25 million and IRR is 19.7%. As shown on the chart. If we pay 1 time EBITDA, the IRR will be as high as 25.5%. On this sheet, we can manage the equity amount we would like to pay. Besides purchase of patients, other costs are $19 million in total, so we can insert an amount larger than $19 million. Patient multiple and IRR could be calculated itself. Part 3. Financials. In this part, we will look into the specific business segments and complete financial statements. Financial statements are created to record and summarize the practice's business process. The activities of 3 business segments, operating segment, investment segment, and earnout, are summarized into 3 statements: the income statement, cash flow statement, and balance sheet. Part 3.1. Original projection. The original model shows results under our conservative assumptions. Later, we will show some further designed models as supplementary. On Charts tab, the first chart shows the net income components each year. Net income grows up steadily both in operating and investment. Practice operating segment contributes to most of the earnings every year. In later years, the practice has more retained earnings that can be used to make investment, so the investment makes more profit in the following years. The second chart shows the operating revenues and costs comparison. For each year, there are 2 columns. The left column shows revenues from 3 kinds of patients. The right column shows the healthcare costs from the 3 kinds of patients and also other operating expenses. Attributed patients are the most important sustainable income source, from which the practice makes most of the revenues and costs. On Operating Segments tab, here the operating activities are clearly explained. The practice has 3 kinds of patients: fee-for-service patients, attributed patients, and ancillary patients. The healthcare cost percentage data is collected from the practice's historic cases. Healthcare costs are percentage of revenues, which is reasonable in the healthcare industry. Capitation will increase annually to provide more capitated patients and less fee-for-service patients. That is to say, under the assumption of fixed population in the community, more patients are capitated, and naturally fewer are fee-for-service. Ancillary patients are fixed at the level of $25,000 per year. The gross margin after healthcare costs will stay at 18% during the 10 years. The tab only considers real growth of Medicare industry. On Financial Statements tab, we can see the complete and integrated financial statements. Income statements shows the detailed sources of revenues and the expenses items. Cash flow statement shows cash flow during the period, mainly for operating activities. The cash balance of $1 million is held to maintain daily operating. On balance sheet, the practice will not hold debt for the next 10 years. On Investment Accounts tab, now let's pay attention to investments. Excess cash from operating segment is transferred to investment account to invest in AAA investments, such as treasury notes and bonds by federal law. In addition, here we will assume a conservative annual return rate of 2%. The investment accounts will worth 136 million in 10 years. Why is 2% very conservative? On Invest Account SP 500 tab, it shows that in the past 2 years, the SP 500 had an average annual growth rate of 10%, quite promising. On Invest Account Growth Rate tab, you can manage your own assumptions. Plug in your annual growth rate, for example 5%, then below it will show the investment account changes under this assumption. The last part of business activities is Earnout account. On Earnout tab, at acquisition, the earnout provision states that each year 10% of net income should be transferred to Earnout account. From year 5, at the end of year, the practice pays the practice seller the exact amount of the Earnout account ending balance. Part 3.2 Attributed Patients Growth Model. On Operating Segments Attributed Growth tab, we use real data in 2015 to make modified prediction. In year 2015, we have 27,000 population. For each year, we assume that 10% of uncapitated people will become capitated. Other assumptions remain unchanged. Capitated population keeps increasing and will reach 65% of all population in 10 years, giving the practice bargaining power. The cash flows and margin do not change much, quite close to the results of previous model. Part 3.3 Inflation Model. On Operating Segments Inflation and Inflation tab, we show the margin is inflation resist. In addition to real growth rate of 5%, the revenues and costs also has a growth rate of inflation. As can be seen from the chart, when inflation rate fluctuates from -5% to 10%, the operating margin each year does not change. The operating segment nicely avoids inflation risk. That is because the revenues and costs increase together by the same inflation rate. The total margin is also inflation resist, since operating margin dominates. On Financial Statements Inflation tab, we can look for details we want to know. Part 3.4 Ancillary Model. For now, the practice is considering to expand their ancillary service. On Ancillary Service tab, we have two examples, CT head and MRI, which are the most common ancillary services. Number of fee-for-service and capitation patients comes from previous projections. Use rate is the percentage of total ancillary patients that will use the ancillary service each month. Revenues are different between fee-for-service and capitation patients. Capitation patients pay 85% of the price. As for revenues and depreciation costs, data sources are shown on Ancillary Data tab. We calculated the average price of CT head machine and use a 10-year straight-line depreciation method. The price that can be charged for a single ancillary test is copied from cms.government. The same method is used on MRI. The gross margin could be as high as 90%. Expanding commonly used ancillary service can save costs and, more importantly, increase profit margin. Part 4 Summary. We hope more people can be aware of the concept of capitation. It creates a convenient primary care method for the community. The projection is quite adjustable. You can input your own assumptions to make a customized prediction. All the existing predictions and analyses are based on real data, so the results are reasonable. The capitation model makes the practice profitable. Under our very conservative assumptions, IRR is 19.7%. The IRR could be higher in an optimistic future.